So I think different investors obviously have very different areas of expertise, very different risk tolerances. I tend to be equity heavy. The equity market tends to be where I feel most comfortable, that I've done the most research, that I like having a lot of my capital in. So I tend to always be equity heavy. And it really comes down to what areas of the equity market I think are attractive. And so, for example, in the past, say, few months, we've had the healthcare sector not performing very well, and partly because there was impending legislation in the United States that could push down drug prices. So that obviously affects American drug makers, but also, I mean, a lot of the European and other large drug manufacturers, United States is their big lucrative market, because we pay more for the same drug than most other countries, kind of just how we've structured things. And so if that were to passed, especially some of the more, so there's like a spectrum. Some of them are really kind of, sweeping changes, but of course, the ones that can actually possibly get through the Senate are watered down. And so as that's kind of gone through, it's become increasingly clear that if something gets through, it's not going to be transformative. And so I think a lot of those got really cheap, and they're actually pretty attractive here, especially because in a period where markets might not do as well, like 2022 compared to such a strong period in 2020 and 2021, healthcare tends to be a more defensive area. And then we combine that with the fact that valuations are attractive. I do like that quite a bit. I also think some of the consumer staples, some of the energy pipelines, basically some of the lower volatility dividend type plays might be a good place to be for 2022, at least for a part of a portfolio. So that's kind of an area that I'm inclined towards. I think, again, going back to cash, I think having some either inflation protected securities or short-term ones that are kind of, they can be used as like cash equivalents, or just outright cash or short-term bonds. I think having some of those is useful because you can rebalance that into any volatility that happens for assets you actually want to own. And again, all it takes is, like, say, a negative 10% year for equity markets for cash to outperform, right? So it's not a super high bar, especially after such a strong period. So I wouldn't be all in cash, but I also wouldn't have zero cash. And then really, property is obviously a more personal decision because it's not just an investment, it's also a lifestyle decision. And so that's, it's partially consumption, partially investment. Of course, people then have, they can have second, third, fourth properties. They can go into publicly traded types of properties. I think that is market dependent. So, for example, I think in the United States, we still have many zip codes that are not very overvalued in terms of property. I think there are still attractive areas of buying property. Basically, in the United States, a lot of foreign capital comes into our equity market. So our equity market is more expensive than similar companies in other countries, which is not always the case. But in this particular period of time, the equity market is very expensive.
Stock market is acting like crypto market. One minute I'm rich, the next minute I'm broke. These volatile cycles make anyone's head spin. I know that. That's why I'm long term, just to keep my sanity. I can only feel for the short termers. It's crazy that it has to be like this to make money in these markets. You have to go out and take more risks. That 60-40 diversification, it's not working anymore. Can't make money in savings accounts. Inflation will eat you alive. So with all this information, what do? Hey guys, it's Jose, your regular Joe Blow, keeping an eye out and my ears open to anything that will help us excel and prevail. So if I'm not reading a book, surfing the internet, checking the web, going through YouTube, I'm always learning on how to invest, looking for ways where to park, what investment tools to use, what asset classes should I look at, what's sexy, what's not, what hedges are available to move into that are safer than the old school way of just saving and diversifying in your portfolio, which is your stocks, from 60-40, meaning allocating 60% to stocks and 40% to bonds, or vice versa, depending on your age. This is not working, and the banks are not working. The banks have to make money. And the way the government is spending, clearly, as a business, they would have gone out of business a long time ago. Lynn Alden popped up on an interview and gave out gems and many gold nuggets. I'll share this video here. First, this is not financial advice. Editor, roll the clip. Fair use.
chopped sideways, maybe it goes down, maybe it goes up at a slower pace. So I don't have a specific view other than that I think it's going to be a less attractive environment for equities than last year and the prior year were.
So, for investors watching at home, what is one to do, given your forecast? If it is choppy, is it best to wait on the sidelines? Is it a wait and see environment? What do you do?
So I rarely make, kind of sweeping portfolio decisions. There's all sorts of tax implications with that. But I overall view that this is an environment for defensiveness. And so that can include having hedges, that can include raising cash, and that can include being diversified into other assets. And so, for example, I still think that there are reasonable choices within the value sector. I think precious metals are attractive. Bitcoin had a large sell-off, and I think that, I think that's also probably going to have a choppy year, but it's more in value territory now. I think some emerging markets are reasonably attractive. And so I think if someone is diversified and rather defensive, they can avoid some of the more severe scenarios while still participating in some of the markets that are actually pretty cheap and that have some growth.
You've been very vocal on the topic of Bitcoin and gold, so let's go there. You mentioned precious metals as a hedge. So you like gold as a hedge right now?
I think it's a reasonable hedge. Basically, that would be a play on the Fed not being able to tighten as much as they're forecasting and that the market's pricing in. If that event starts to occur, you probably would expect a weaker dollar, stronger gold, maybe balance in some emerging markets. And so I do like some of those plays. You can consider kind of emerging markets to be the more volatile, growth-oriented way to play it. So, for example, I've been bullish on Brazilian equities. I think if you look around broad emerging markets, especially emerging market value, they're reasonably attractive. But of course, they have, there's a lot of risk. There's a lot of volatility. Gold is a somewhat less volatile choice, a more defensive choice. It generally does well in economic decelerating environments, especially if the Fed is forced to be less hawkish, even if they're still being hawkish. They're still tightening, but maybe less aggressively than the market priced in.
As tensions between Russia and Ukraine escalate, could this be a black swan event?
Oh, absolutely. I mean, gold tends to move on these crisis events. Over the longer run, it's really about what happens with the currency. But if you have, if this disrupts energy, it seems like it's going to disrupt fertilizer to some extent, to the extent that it causes inflationary pressures, especially stagflationary pressures, rather than that kind of, pro-inflationary kind of, bounce back type of scenario. If it's actually more of a stagflationary supply side issue, that can be quite good for gold. And so it's one of those kind of tail risk diversifiers in a portfolio.
Before we get to Bitcoin, just curious to get your thoughts on the US dollar. I was watching back an outlook of yours last year where you were quite bearish the US dollar. In fact, you said you've been bearish the US dollar since 2019. Have your views changed or the same?
So for the most part, no. I turned bearish in late 2019. We did get that, that we had obviously the spike around COVID. That was kind of that tail risk. And then we had a decline throughout 2020. And I started to get neutral towards the end of the year where I was still structurally bearish, but we had, been rather oversold. And because I tend to be somewhat contrarian, I was concerned with how much people jumped onto that side. And so I was temporarily neutral on the dollar. That rally extended a little bit longer than I would have thought. We got a little higher and longer than I would have thought. I'm still bearish here, but I'm watching price action to see if it starts to confirm it. And so
Mm-hmm.
some of the things to watch, I think, are capital flows. So a lot of people focus on rate differentials, but it's also about how attractive U.S. growth equities are for the rest of the world. So if the rest of the world decides to pull out of some of those large cap equities, that would be dollar negative. And a similar thing that would happen in the early 2000s when a lot of capital pulled out of the NASDAQ bubble, that was dollar negative for the next few years. So I think that's my base case. But it is, you're comparing it to the euro, you're comparing it to a bunch of other weak currencies as well. So my broader view is that fiat currencies in general are going to devalue with negative real yields.
Let's talk Bitcoin now, Lynn.
And so generally the type of period we're in now has historically not been great for Bitcoin's price action. Now, eventually you could get a decoupling, but right now Bitcoin's classified due to its volatility as a risk asset by most pools of capital. And so I'm not particularly bullish, say, for the calendar year 2022. My base case would be, kind of choppy action. Right now, I would describe this as being a kind of a value bear zone where I think it's good for dollar cost averaging, accumulation, developing plans to accumulate for corporations or other pools of capital. I wouldn't describe this as being at capitulation levels. So we certainly, if you get some sort of market turbulence, You could have a capitulation similar to March 2020 or similar to the fourth quarter of 2018, where, as we talked about, the Fed was trying to still tighten into a declining PMI environment. If you get a capitulation like that, I would consider that a buying opportunity. I don't know if we're going to get that or not. So we certainly could see a break below 30,000 in that kind of capitulation type of environment. But structurally, I think looking at multiple years, say a 3 to 5 year time period, I'm still structurally bullish on Bitcoin when I look around the ecosystem. I look around what's happening on the Lightning Network. I look around kind of every cycle, the infrastructure gets built to absorb new types of capital. So first it was peer-to-peer, and then it was the early exchanges that didn't, had trouble getting bank access, and then it was the more regulated exchanges, and then it was the more institutional grade custodians and larger pools of capital coming in. And I think that trend is still intact.
Lynn, in the face of red hot inflation, what is the best asset to own right now?
So I think I have a diverse approach to mainly towards the commodity side. And so I think, if you look at what specifically does well in an inflationary environment, energy, for example, it's hard almost by definition. If you have inflation, you're getting inflation in energy and other key industrial commodities. And so I think that remains an attractive environment. Now, I think we've kind of come pretty far pretty fast, so I wouldn't be surprised to see periods of temporary softness. I think most indicators, especially with the economy decelerating to some extent, I think year-over-year CPI could start to peak potentially by the end of the quarter. Now that if we get some sort of key energy shortage and we get a spike in energy prices, that could prevent that from happening. And so overall, I think my focus right now is kind of on defensive value. So things like energy transport infrastructure, MLPs, for example. I think there are healthcare stocks that are attractive. I think there's a variety of ways to get yield, and then having exposure to gold, Bitcoin, copper, energy producers gives you that upside if you get that more inflationary type of environment.
I know for sure I got some of those gems down on my pad. I'm researching and moving accordingly. Thank you guys for your continued support. Stay free.